This is Radio Free Wall Street with Lee Adler on the web at radiofreewallstreet.fm and wallstreetexaminer.com. Hello, this is Radio Free Wall Street, and I'm speaking to you on Monday, August 25th, 2014. I'm Lee Adler. Well, this weekend we had the Fed's Jackson's Hole conference, and there was a lot written about it. The words were flying. I thought I'd better break my normal procedure and actually read some of the stuff that was written about the conference and some of the things that central bankers said there. As you know, I rarely, if ever, read anything written in the media. I basically limit myself to following my Twitter feed and what you folks have to say on our message boards from time to time. I pretty much limit my reading to the reading of data and the constructing of charts and looking at pictures, rather than paying any attention whatsoever to what other people write about these things. Kind of like the blind leading the blind. I realize that most of you don't have a choice about that, so you have to do some reading and you have to kind of figure out what makes sense and what doesn't. But if I was going to give you a piece of advice, I would say, well, if you don't want to get into the data yourself, and I realize that from a time perspective, it's just not feasible for most of you, then at least just look at the pictures and absorb what the pictures have to tell you, the graphs, the charts of the data itself. They all tell a story. And that's what I try to do on these video programs, is to show you some of the charts and give you my interpretation of the story of what they're telling us. And I think that it's important for you to spend a little time on those charts and decide for yourselves what these things really mean. Because my experience in reading this weekend was truly stupefying. I just got the feeling that here we have all these central bankers that are making it up as they go. They really don't know what their next step is going to be. They're sort of responding to whatever the environment is giving them, but they're not even sure about those things. So we get these processes where they start moving in a certain direction and they continue to move in that direction until the situation becomes untenable, and then they begin to move in another direction. And the words written about these processes are emblematic of the confusion, and the pundits are sort of shooting in the dark themselves. You read all these contradictory statements from these central bankers and the people that are interpreting them, and what you end up with is just a ball of confusion. It really doesn't make a lot of sense. So let's stay focused on the data itself. Let's look at the graphs and see where things are going, because ultimately the markets follow the money. The central bankers want you to think that the words matter. But in my observing this stuff closely for a very long time, I've come to the conclusion that words don't matter. I'm not saying they don't matter at all. They may matter in the very short run from time to time. But trends are dependent on the liquidity itself. And so let's take a look at those. I've got a couple charts. First of all, I did a combined chart of the balance sheets of the Fed, the ECB, and the Bank of Japan, all in one line. And I think it's really instructive because it just shows how high the correlation is between the direction of these central bank balance sheets, the central bank assets, and the securities markets. Now, some of you have asked me to show what went on prior to 2009. Well, prior to 2009, there was no correlation, or very little correlation. The correlation only began with this massive balance sheet expansion that took place concurrently beginning in 2009. That's when the central banks created so much excess cash that the players were forced to move with it into whatever securities happened to give them the best return. So The primary dealer systems that are in effect vis-a-vis the Fed and the Bank of Japan, those primary dealers take that cash that's being forced upon them and use a small percentage of it to speculate in carry trades, interest carry trades, say with U.S. Treasuries, or with stocks or with commodities. And we've seen this process several times, but I'm going to show it again, both on the basis of the combined balance sheet of the three major central banks, and then on the basis of deconstructing those three so that we can see how the Bank of Japan, the Fed, the ECB may impact the markets differently at different times. So let's take a look at that, and let's try to stay focused on the data itself rather than all the words that are flying around about it from a bunch of journalists who really don't seem to have a grasp on what's going on any more than the central bankers do. I thought it would be enlightening to take a look at the combined balance sheets of the Fed, the Bank of Japan, and the ECB on a chart quoted in dollar equivalent terms. Over here on the left scale, you can see the numbers with all these zeros, but basically the bottom of the chart beginning in 2009 is $3 trillion, $3 trillion US dollars equivalent, combined total balance sheets of the Fed, the ECB, and the Bank of Japan. Started here at about 3.1 trillion in early 2009. By August, the current number is up to just under 8.4 trillion. That's an increase of 170% since 2009. The total balance sheets of the Fed, the ECB, and the Bank of Japan have risen 170%. Now let's look at the S&P. Bottomed here in March of 2009 at about 700 more or less. And since then it has risen to today 2,000 on the S&P. That's a gain of 186%. So while the combined balance sheets of the Fed, ECB, and the Bank of Japan were increasing by 170%, the S&P has risen by 185%. That's pretty close to a one-to-one correlation. You don't get much closer than that. Now you can see that the correlation isn't exact. Look at here in 2011, U.S. stock prices dropped. The combined balance sheets were still growing. What I'm going to do is deconstruct these three balance sheets for you so that you can see how each one influences markets separately at different times. There are times when one or two or all three of these balance sheets are growing at the same time, and there are other times, such as since 2012, that the ECB's balance sheet, for example, has been shrinking while the Fed and the BOJ balance sheets have continued to increase. But at least here we have a picture of the overall correlation. Is there cause and effect? Well, of course. I mean, there are those who will argue that correlation does not imply causation. My answer would be it certainly does imply it. It may not prove it, but it certainly does imply causation. And I think there's enough reason to believe, given the fact that Ben Bernanke himself said that stock prices would rise as a result of QE, that there is a direct correlation. As we well know, the primary mechanism of the transmission of monetary policy by the Bank of Japan and the Fed is via the primary dealer system. So when the Fed and the Bank of Japan buy securities from primary dealers, it cashes them out and then they decide what to do with that cash. So that's why that not only is there a strong correlation, but that this relationship is almost certainly causal. Let's look at the individual balance sheets. On this chart, I'm showing the balance sheets of the Fed and the Bank of Japan, again in dollar equivalent terms, so that you can see the rough proportion of the size of the two balance sheets and the change over time in the two balance sheets. And again, I've overlaid the S&P 500 here in green. Now, this is an illustration we've seen before when the Fed paused in 2010 and in 2011. Initially, U.S. stocks sold off here and here again in 2011. This is 2010, 2011. As the Fed paused, we went into a sell-off. Now, the Bank of Japan was doing virtually nothing to increase the size of its balance sheet in 2010, so that the market wasn't really getting any help here from the BOJ. Again, these are the two central banks that use a primary dealer system. In 2010 and 2011, the Bank of Japan did begin to expand its balance sheet a little bit, approximately concurrent with the Fed, late in 2010. And U.S. stock prices really took off as a result, particularly as the Fed was very aggressive in its expansion of its balance sheet. Okay, so then in 2011 we had the pause. Both the Bank of Japan and the Fed were doing very little. But then it's a little hard to see on this graph, but the Bank of Japan also began to expand its balance sheet from this low here early in 2012, when it was around 1.3 trillion US dollar equivalent, pushed it up to about 1.5 trillion. So a $200 billion increase in the space of 6 or 7 months here was certainly enough to give U.S. stock prices a boost. At the same time, not shown on this line, the Fed was starting to buy mortgage-backed securities to replace those that had been paid off from its balance sheet. So that kept its balance sheet flat, but remember, it was buying those mortgage-backed securities from the primary dealers. It was cashing them out at this time. So we started to see some cash flows into primary dealer accounts in 2012 from both the Fed and the Bank of Japan. They got more aggressive at the end of the year, and that's when QE3 began. The first settlements took place in November of 2012, and from then on, it was pretty much a straight line. Both the Bank of Japan and the Fed have been very aggressive in buying securities in 2013, 2014. Fed began its taper here early this year. You can see the Fed's balance sheet beginning to flatten out, but the Bank of Japan is still going gangbusters in dollar equivalent terms. This year, it has increased the size of its balance sheet from about 2.3 trillion to about 2.7 trillion, or $400 billion over the space of 8 months. That's 50 billion a month or so, and you add in another 50, 60 billion from, or say 70 or 80 billion from the Fed up here, and then it began to slow. We're down to about 40 billion a month at this point. Still enough, I think, to keep things perking along. On the next chart, I'm going to add in the chart of the ECB's balance sheet. And while the Bank of Japan is still rising rapidly and the Fed is tapering, the ECB's balance sheet has been shrinking. So let's take a look at that. One of the things that came out of Jackson's A-hole this week is speculation that the ECB is going to begin a program of quantitative easing. The articles that I read were basically a lot of double talk. You know, Draghi made a statement that could have been inferred that he was talking about QE, but there are immense regulatory obstacles in terms of the rules of the ECB to buying securities outright, especially government securities, although they probably could buy different kinds of private securities. One of the things we have to consider with the ECB is that they don't use a primary dealer system. They don't buy and sell directly with primary dealer networks. They basically issue loans to member banks of the European Union. And amongst the players, of course, are the big U.S. banks, Goldman Sachs and Citibank, J.P. Morgan. They're all over there participating. It's all one liquidity pool, and the three central banks are all pumping to the same pool. While the Fed and the Bank of Japan were kind of dormant in 2011, not doing much, the ECB was in the midst of its crisis here with the blue line, and they became very aggressive in adding funds to the system via monetary operations, which consisted entirely pretty much of emergency lending. They don't buy securities outright. So the loans are kind of on a voluntary basis. The banks take those loans when they absolutely need them, when there's an emergency, when there's a crisis, and they're going to collapse without them, they'll borrow. But if they don't need the funds, here's what happens. At the end of 2011 and early in 2012, the ECB instituted what they call the LTRO, the long-term refinancing operations. They were emergency loans in response to crisis. and the ECB's balance sheet shot up from about 2.4 trillion euros to about 3.1, 3.2 trillion euros. But what happened after that is that the ECB allowed repayment of those loans beginning in 2013, at the 1 year anniversary of the inception of the LTRO here. Now, since these are loans, the banks and the traders were reluctant to buy securities with them, and as a result, they use them to fund a U.S. Treasury carry trade. And we can see the rally in treasuries corresponding to this increase in outstanding loan balances from the ECB. So that we had this Treasury rally. As soon as they stopped the LTRO program, the banks began to slowly delever. They didn't need all these funds, so they began to pay them back and to unwind the Treasury carry trade. When the LTRO became eligible for repayment, the banks became very aggressive in repaying those funds, and the ECB's balance sheet has shrunken radically. Along with that, there was a big sell-off in treasuries. Now, beginning in 2014, the treasuries rallied in spite of the fact that the ECB's balance sheet has continued to shrink. There's a lot of reasons for that. It seems like everybody else suddenly became enamored of treasuries again, including the public. Primary dealers have been kind of getting out of them, but the foreign central banks are still buying heavily at the auctions. So there's still some support for the treasury market. I certainly don't think we're going to see anything sub 2.3, 2.2% on the treasuries, but that's a subject for another time. Basically, what we want to look at here is that the ECB's balance sheet has continued to shrink, in particular since the inception of the interest charged on reserves, the 10 basis points. The banks have basically been paying off outstanding loans from the ECB and getting rid of their deposit balances at the ECB in the process. So the ECB has this big problem of balance sheet shrinkage, and now the scuttlebutt is that in line with Draghi's original statement that he was going to do whatever it takes to prevent deflation or to prevent financial collapse, the speculation has begun now that the ECB is going to do some kind of quantitative easing, outright purchases of securities. And isn't that ironic that as the Fed is winding down, now they're talking about the ECB is going to take the handoff. I don't know what the ECB is going to do, and all the speculation about what the central banks are going to do, all the talk, all the word clouds are really kind of a sideshow, because as we've seen over and over again, the markets respond to the flow of funds, not to the flow of talk. So we'll let the pundits go on and on and on about that. We'll stay focused on what the Bank of Japan is doing, and they don't intend on slowing down at all. There's no inkling of that coming out of the BOJ. So we're still going to see the rough equivalent of about 50 billion US dollars per month from the BOJ. The Fed is going to wind down its QE, but it'll continue to purchase 15 billion of MBS from the primary dealer. So we're still going to have that 65 billion flow into these overlapping primary dealer accounts between the Bank of Japan and the Fed. Meanwhile, the ECB's balance sheet has continued to shrink, but it's not going to shrink enough to turn the worldwide total balance sheet of these major central banks flat. As long as they're upsloping, I think it will be difficult for the markets to go into a bear market. At least we might see a 10%, 12% correction, something like that. Prior to 2009, when all this quantitative easing and massive balance sheet expansion by the central banks began, there was far less correlation, virtually no correlation between the direction of central bank balance sheets and the direction of the markets. It really only began concurrent with quantitative easing and balance sheet expansion. Those excess funds that the central banks created had to find their way into securities because they really had nowhere else to go. A certain portion of the holders of these funds simply do not want to sit in non-interest bearing assets, so they're going to deploy these funds into securities, and we see the impact on securities prices. So let's stay focused on the actual balance sheets themselves and their directions, and on the technical analysis to get the best handle on where things are headed. These word clouds that are coming out of the media and the central banks are really a diversion, the confusion of confusions, and we want to try to stay focused on what matters. So are these correlations or causal relationships going to persist indefinitely? We don't know. Things change over time. Yes, history repeats to an extent, but these drivers may begin to change as these central banks eventually pull back from this massive balance sheet expansion. I guess the big question we have to face is whether indeed the ECB is going to start a program of quantitative easing that will continue this 45-degree angle on those charts that we just looked at. In spite of the Fed pulling back, is the ECB now going to take the handoff? Well, Mario Draghi has been all talk and not a lot of action, and his programs, his most recently enacted programs, have been actually counterproductive. They've caused the ECB's balance sheet to continue shrinking. So at some point, will the ECB step in? We have no way of knowing, but we just have to keep an eye out for that. If the cash does begin to flow, and if they do begin to buy securities outright, then it's likely to have a similar effect on the markets that the Bank of Japan and the Fed's buying has had, as long as that combined total line keeps moving up. If they get to the point where something causes them to end this massive balance sheet expansion, at that point, we're going to see a major readjustment in the markets. But we're not there yet, and I don't see the point in speculating on something that hasn't happened and isn't about to happen anytime in the immediate future. From the standpoint of technical analysis, we still have projections in the short run that point to about 2050 on the S&P 500 and potentially higher than that, given some of the long-term projections that point as high as 2200 plus, with the cycles pointing to a high in 2015. So as long as the Bank of Japan continues to flood the system with money on its behalf and the Fed adding a little more on top of that, then I think these markets are going to continue to perk along for the time being. So that'll do it for this week. Next week is Labor Day. We'll take a week off next week, and we'll get together again on September 8th, Monday, September 8th. Until then, have a great holiday weekend, trade sane, and we'll see you on September 8th. This has been Radio Free Wall Street with Lee Adler. Find this program on the web at radiofreewallstreet.fm or wallstreetexaminer.com.